Hello all, I hope you are well in these extraordinary times. I would like to welcome you to the Fintech Finance Virtual Arena where we're hosting you today. In this special arena, we're going to be looking a little bit at the insurance market and IFRS 17. Joining me today, all the way from, Brian, I actually don't know whereabouts you are at the moment from Aptitude. Whereabouts are you in the world?
I'm in the sunny Bishop Stortford.
Ah, very nice, very nice. Long.
I'm near
long
Stansted
weekend.
Airport. Yeah.
Excellent.
Very
And
countrified around here.
across the pond over in Austria, we've got Eduardo Damer from. I'm going to completely mispronounce this, but I'm going to go for it again. Eduardo Damer from Q Perio.
Yeah, it's Eduardo Dalma, so that's fine. And I'm not in Austria, I'm in Germany, but it's all very, very close to each other. So.
Apologies there. I saw the Austria word when we were doing the screen share earlier. So first of all, to get right into it, do you think that it's fair to say that insurers underestimated the complexity of IFRS 17? Brian, why don't you take that to start with?
Yeah. Certainly. In our experience, we had in implementing over a dozen IFRS 17 projects. Most clients have significantly underestimated the complexity. Indeed, as a vendor, I think we also may have underestimated the complexity, particularly in some of the accounting aspects. Converting the actuarial results data automatically into accounting transactions has been particularly difficult. But we've also seen a number of extra areas of complexity. Interpretation is one. The standard in itself is fairly principles based, rather than a more static framework such as Solvency II. And I think interpretations of the choices that you have has been a significant problem. There's also been numerous accounting choices that clients have to make, including posting changes in the discount rates to OCI, the impact of these on their results. There are also decisions relating to the unit of account, the measurement models, and the approach taken at transition, all of which are critical really to setting future financial results. I think also there's been complexity in calculating the CSM, releasing and tracking through to the P&L. That's been one of the most complex areas. The loss component has also been the subject of significant debate. The exact calculation method, which cash flows are to be considered, and the runoff methodologies. But I think probably one of the biggest areas has been underestimation of the PAA model. Generally, this has proven to be much more complex than initially thought. The nature of the P&C business, the myriad types of products, commercial, personal lines, reinsurance, dealing with long tail claims, and then discounting and adding a risk adjustment, really has been quite complex for P&C insurers who are not familiar with those approaches. Indeed, I think it could be argued that it would be simpler actually to adopt the GMM for all business. This makes the whole exercise simpler, particularly as you may need to use the GMM to validate the PAA approach. I think this is something that Eduardo, you had some few comments on.
Thank you, Brian. So I think, it's a journey, IFRS 17 in general. And while we have dived into the majority of the topics during the early stages of the projects, kind of in silos, which I think was necessary in order to grasp the complexity, now we're trying to pull all those pieces together, and we're facing problems related to how do we operate this and how do we transition this later on into our real business. And I think as the majority of the IFRS 17 implementations progress, the shift from those elements in detail now to how do we operate this is now becoming apparent, and you can see it in examples like how to integrate the forecast and planning into the entire flow of IFRS 17 data. So I guess there's much more to it than anticipated. Another element is At the beginning, it was very technical from a, let's say, business perspective as well as from a technology perspective. And now it's moving more towards the storytelling and how do we use the tool in order to influence the message that we want to get across to the investors by using IFRS 17, as well as the comparison between IFRS 17 and all the other regulatory regimes that the majority of our international insurance customers have to adhere to. So there's a lot of complexity associated with it, and the learning curve is there for all of us, everyone that is involved.
Yeah, I would agree with that, Eduardo. I think also we've seen some of our clients struggling with the VFA methodology as well. That too has got its own unique complexities in determining which contracts qualify for the VFA participating and unit-linked participating have been causing problems, dealing with things like mutualisation, risk mitigation factors, and complexity around dealing with embedded options that you get sometimes, particularly on pension contracts with guaranteed annuity rates. Reinsurance, dealing with the groupings, there's a whole raft of issues that have proved to be complex when you get down to the operational level.
Well, you mentioned obviously some of the various approaches to take. How do insurers decide which implementation to take, whether it be premium allocation approach or variable fee or general measurement model? What's the methodology between deciding this is the most suitable here?
I think through some general points, I think implementing IFRS 17 will have a significant impact across an insurer's actuarial and finance operating model. And this to a degree will be reflected in the size of the project. Understanding the implications of the new standard on an insurer's business model will be essential in developing the appropriate strategies and responses. Indeed, ideally we'd like to see insurers have a new target operating model, specifically for IFRS 17, although in practice very few have actually gone down this route. The size and cost of an IFRS 17 project will vary significantly by the approach taken by an insurer. You can categorise the approaches in three main categories. One is minimal compliance. This is where the insurer has taken the view this is purely a compliance exercise and it's going to do the minimum spend to achieve the objective. That might be fine for small insurers, but generally it's not been adopted by the larger ones. Moving on from then, there's minimum compliance with the added efficiencies needed to perhaps to improve some of their reporting cycles and some automation. It's kind of a halfway step really. And the third one is to use IFRS 17 as a catalyst for a full digital finance and actuarial transformation program that not only supports IFRS 17, but as Eduardo mentioned early on, supports the whole raft of regulatory regimes.
Oh, I like the sound of that.
Yeah, that works really well. So IFRS 17 will require insurers to look at all aspects of their finance and actuarial and government systems and processes. You'll have to modify your accounting policies. That will drive changes in design for your chart of accounts, generally, and importantly, it will develop new performance metrics that will be necessary when you look at running the business. We'll deal with that a little more as we move through the webcast.
The thing about regulation as a whole, and this is across industries, is there's almost two trains of thought. There's the technical side of things, but then there's also the cultural, the spirit of the regulation, which I almost feel that if you adhere to that, then all of the technical things sort of fall into place. Would you say that's the same with IFRS 17?
I think so. I think you're looking at an area where, I think you get a question here is what aspects you're taking off IFRS 17. It comes back to what I mentioned earlier on. Are you looking at something as merely just a compliance exercise, or are you looking for this to actually, drive change in your business and use that to provide some kind of business benefits and structures, whether that just be on IFRS 17, but also on things like Solvency 2. So I think that's a kind of approach I think that, looks at determining the best choice of how you approach it. I think if you do minimal compliance, you really are, taking almost a backward step and doing what some of the insurers did on Solvency 2. Eduardo, have you any comments on this one?
I think it's also important to understand that we will have a major shift in responsibilities. The involvement of the actuarial departments into what goes into the balance sheet and income statement is radically shifting in the way that IFRS 17 is collecting the numbers. And that also entails that every project has a change management component from an organizational perspective that we need to tackle as well. I think that's more than just the general introduction of an accounting standard. The other element is the storytelling, and I think insurers need to be very smart and in the way that they apply the respective measurements and be tactical also in the way that they apply them in order to tell a story that is useful for them.
Do you think, Eduardo, that being Solvency II compliant was a bit of an undertaking? Is there any scope for reusing current systems and elements to help with IFRS 17 and regulations beyond that in the future that haven't even been written yet?
Yeah, that's a very, very good question. So I think we see a huge difference in the way that these programs have been approached under European regimes, where Solvency II applies for the majority of the players, and implementations that we support in the US, Canada, or other parts of the world where solvency is not existent. Of course, we have to face that solvency is a bit of a different animal, right? So we have reports which are very, very specific, as described in the QRTs, and it's only happening on the balance sheet, so the P&L is not involved. Yet you can, of course, reuse a lot of the elements, the cash flows that are generated through actuarial engines, best estimate liability as one example. Also, the application of a discounting as well as a risk margin are similar concepts that can and should be reused out of solvency, because otherwise you of course will lose the capability to also draw some comparisons between Solvency II capital and IFRS 17 reporting. However, there are also good reasons to deviate to a specific extent. Yet we see that there is an advantage for those that have used that framework as a starting point. However, when we started the implementations, the majority of the comments that we received is, let's not repeat a Solvency II implementation. So that's been a very painful experience for the majority of the industry. And therefore, I think what we need to apply here is to really look into possibilities of reusing every regulatory move into creating something which will be able to help us also with the next one, because there's always an IFRS 22 coming or an Solvency 3 down the road. We recommend for that to operate with something, we call it an integrated risk and finance architecture, which clearly determines which will be the source systems, which kind of calculation engines do you need in order to calculate figures for different accounting regimes, where you can centralize kind of your business rules and then float all the data throughout your accounting systems, ideally in a highly automated fashion that enables you to spend more time on the storytelling, the validation, as well as the comparison, instead of, like in most of the cases today, operationally requiring 80 to 90% of the effort into creating the numbers. So I think it's a good idea to sit back whenever you start such a big undertaking and consider, what do we want to create? How do we want to implement this into our architecture to create some stability? And then also, how do we want to leverage this then down the road? You always have the advantage that it's a regulatory mandatory project, so budget will be available. So you better use it in a smart fashion so that you incrementally build that architecture. It's nothing that is there overnight, but it's definitely something that you will be able to reuse the next time somebody comes up with a new idea.
Yeah, I'd like to add, I think I would also agree. I think certainly from experience, I worked on many Solvency II programs, and a lot of them were based on a minimal compliance, minimum cost approach, using a somewhat disjointed methodology. I think now a lot of customers, now they're into IFRS 17, have recognised their mistakes and are looking back at their Solvency II systems and processes and trying to improve them and integrate them into IFRS 17. I think if you look back generally, Solvency II is a critical measurement for most of our clients. So they are looking to be able to develop something which I would term as a comparator. They can look at the differences between Solvency II and IFRS 17 and build a bridge between the two, so they can explain internally and externally the differences between the two sets of results. And effectively, the capital that you have to run an insurance company, which is Solvency II, and the profit that you emerge in the revenue, which is IFRS 17, are key metrics really in running the business, and being able to reconcile, in inverted commas, between the two is an important facet.
Well, I want to talk operations. How is this delivered, but also how is it tested, and how will it flow through the process?
Yeah, that's I guess the challenge, where the majority of those that are already more advanced in the programs are. As mentioned earlier, the silos were required in order to undertake the specific steps of the journey to understand in detail elements and how they impact your business model and how to apply for them. And also to see whether you qualify for this or the other. So I guess that's kind of the initial stages, and then you need to basically ensure that everybody comes back from the deep dive in the silos and starts to put everything together in a sequence, in a process. I think what is important for that is to have a strategy on how you create use cases. That's why we always recommend to use a specific element of agility in the programs where applicable, and of course where possible, because everybody's enabled to run agile, and to use kind of the use cases or stories as a starting point. You should start with something which is simple. I mean, I would go for initial recognition, not too many different elements happening, and trying from the beginning to get from end to end. So that enables you to determine the scope for each of the cycles that you approach. And it also enables you to see how you progress. Of course, not every interface, not every activity not every function will be available end to end in the initial ones, but it always creates a clear perspective on what we're doing and how are we doing it. And then moving from there, you need to add the complexity. You need to add more data volume in order to really get to cases which are much, much closer to the effects that you see in reality. We always recommend, because this is from an operational perspective always the most stressful moment to operate, either under a quarterly end result or a year-end result, and use the closing calendar as a basis to determine also these stories. That helps not only understanding the sequence of the work that you have to do, it also helps you to understand whether there are gaps in your design, and of course it helps you also to determine what level of automation will be required in order to meet the deadlines. Because let's face it, with IFRS 17 we have much more to do in much less time than we had under IFRS 4, and the due dates do not change a lot in the majority of the cases. So the question is, of course, where is this additional activity then going into? If it's not automated, we will definitely run into a problem. With regards to the testing, the only recommendation that we can give is to test very, very often. Make sure that the individual components actually operate before you put them together in a sequence, and try to test as much as possible end to end. Why is that so important? Let's face it, the business is doing this for the first time. These IFRS 17 figures are all understandable based on the standard, but then when you see them processing through the system, you need to first build trust in the solution that you have built in order to guide some of the ultimate design decisions, because you work under a lot of assumptions, and if you don't see those assumptions operating under a full load with all the complexity and all the bells and whistles that you need from a functionality perspective, you will not be able to determine, is this the right path? Am I using this tactically correct, or am I putting myself into a situation that I will not be able to correct, like the transition approach that Brian initially mentioned, right? So you decide for one and then suddenly you realize, oh, that was not the right one. There's no way of getting back to it. And so in order to get there, you need to run these tests a lot. because ultimately the phase that is the most important here is the transition to business, which means that from an operational perspective, people need to understand what they have to do, so the steps, but they also need to understand what is the result of what we've created in order to be able to tell a compelling story to the market.
Yeah, if I can add to that, I think we've seen our customers move towards your term real life scenarios. I think you certainly do need to have these real life scenarios so that the business can understand what's happening in IFRS 17. You've also got a number of training and educational issues that need to be covered. There's internal training, there's training to the management, training to the board, and also communication to the rating agencies and the markets generally. As IFRS 17 is a new regime, the market is going to be particularly interested in the figures that come up and transition and moving forward. I think a couple of other points, if I may also. IFRS 17 being new means that you're going to have to do quite a lot of planning and forecasting, which we'll cover a little more detail later on. But IFRS 17, as part of your project, you're going to have to integrate with existing budgeting, planning and forecasting tools. And of course, you're going to have to change your actuarial models. And there's a strong interaction between your actuarial models and your budgeting and planning and forecasting tools. Just to reiterate, the importance of the IFRS numbers at transition is vital, because that's going to set how your profit emerges over future time periods. So the ability to be able to look at multiple choices of your transition numbers is important. I think also, as Eduardo mentioned, operationalizing IFRS 17 is now the big problem. As customers now start moving towards the implementation date, embedding in the business and doing all the testing is critical, really. So, points like automating through the whole life cycle is becoming increasingly important.
Absolutely. Well, with all of that in mind, what's the end game? What is the in an ideal world? What is the result, and how can an insurer achieve an optimum IFRS 17 result?
I think that's an interesting point. We've come across this phrase, if I may use it, IFRS 17 optimal result. This is really an interesting topic, because in most cases, insurers have got a whole wealth of metrics and history which they can base their results on. With IFRS 17, it's brand new. And when you get to implementation, the insurers are going to be wanting to ensure that their IFRS 17 numbers, particularly the CSM, they're happy with. As we both spoken several times on, your numbers at transition are important both at that point and for future accounting metrics as you move forward. So I think what clients are going to have to look forward to is some kind of ability to undertake simulation and forecasting activities. This is because effectively, there are going to be new KPI metrics. Your CSM is going to be very important. Your risk adjustment is going to be very important. Your insurance revenue are going to be important. So the ability to be able to, prior to transition, to be able to look at a number of scenarios that generate out your results and change various assumptions and produce a whole range of results. And then the actuaries effectively to look through those and use their expert judgment to define what actually is a good set of IFRS 17 results. So I think there's going to be a lot of simulation. Now that might be, for example, changing the way in which your CSM run-off patterns emerge. It might be changing discount rates. It might be changing groupings. It might be changing the relationship between the risk adjustment and the CSM. There are a whole range of factors which you can effectively regard as variables and use those to simulate multiple scenarios. The other point of view is, of course, you need to then look at the way that impacts on, for example, your balance sheet. So you need to be able to take a baseline balance sheet and project that forward over a number of years and to see what the ultimate results are.
If I would like to add also two elements, right? So depending on who you ask, right? So if you go and ask a CEO, he might say comply without breaking the bank has been kind of a success in an IFRS 17 implementation. But setting that aside, I think it is important to really use the opportunity to create something which is integrated, something which has a clear ability to be scaled for other purposes as well. Because let's face it, the regulation is new, and once it is applied and once it is in place, it will undergo changes. So which means if you have hardwired everything that you're doing, you will always be, investing into your system as you proceed, as well as require much more effort from your organization. So I think the end game should be that you have something in place that is ideally better than what you had before you started this journey, something that can be leveraged, and something that is preparing you in a much better way for your regulatory future. I don't believe that in the first version we will have really something that the insurance industry will adapt as the only measurement for how they run their business. I think they have parallel types of views that are potentially more acquainted to how an insurance really runs. And so my hope is that in this endgame we will at one point try to align these different views that from an operational perspective need to be provided, so that we can be operating more unified in terms of the information that goes to the market, but also the information that is necessary for the management to make proper decisions on how they run their business.
Absolutely. Well, the last thing I kind of want to ask, just to wrap everything up, is culturally, is there anything that insurers, in terms of their attitude to IFRS 17, are not doing that they should be?
That's a complicated question.
Yeah.
Because they have asked for this, right? So when IFRS 4 was introduced, criticism in the industry was there since day one, and I think they were fully right in raising that. IFRS 17 is kind of trying to align and get transparency into it. So I think there's a benefit, of course, just in general going into that direction, because insurance potentially in the market is not perceived as a sexy investment, because you have to understand so much what they do in order to become a savvy investor, like a Warren Buffett, right? So is the result now really something that they're pleased with? Out of my experience, it's a burden more than something that is really welcomed. They're operating, of course, a lot in trying to comply with it. But I see also some collaboration, which I think is important to tackle some of the topics beyond the TRG group that is dealing with transitional topics. You see the industry, and to a certain extent, more unified. Whenever you have a common enemy, it's easier to unify. And I hope that this will help to standardize some of the elements to become a little bit more industrialized, because that specifically now in times like these where we're facing a lot of claims, it is important to operate in a lean fashion and also have a certain level of industrialization available. And it's going back to the architectural topic again that we discussed in the beginning. My hope is that this is a good starting point for them to realize that there's more to win if we try to unify than potentially to lose.
Yeah, I think one other point also is that as IFRS 17 comes on top of things like Solvency 2, I think we're seeing now, particularly for IFRS 17, that it's driving a greater relationship between the actuaries and accountants. There's not really existed before, because obviously in IFRS 17 the numbers are heavily influenced by the actuarial side, yet the accounting still has to be measured and run through systems. And we're seeing now greater interaction between the actuaries and the accountants than we've ever seen before. So I think that's a good thing. We also, I think, as Eduardo said, insurers do regard this as, to a degree, a burden. But then you have to look at the other side of the coin. Are there any business benefits that you might be able to drive out of the project? One of those might be, as you're now seeing greater interaction between your actuaries and your finance people, is it now time to look at an integrated finance and an actuarial type approach? I think we're starting to see that now come through in projects as people now move on into IFRS 17. They learn from their experience from Solvency 2, and they're now looking at potentially, how can we improve our overall risk and finance architecture. And hopefully, that will help to reduce the overall costs. And importantly, it's not just about costs, it can provide you with insights into the way the business is run. For example, you can look at ways in which, you can use the two regimes to look at views of profitability of certain types of contracts. You can look at the way in which you might optimize the way you use reinsurance. There are a whole raft of areas where the amount of information you are now generating, particularly for Solvency II and IFRS 17, can be used to provide insights into running your business. So if you move beyond just a simple compliance approach, there are benefits to be had, but it does require you to be able to store all that data, to analyze it, and to be able to look in depth at your business.
Brilliant, excellent. Well, guys, thank you so much for this. This has been quite insightful, and also from a strategy level, I think very useful. Where can we find out more about you guys? Brian. TikTok.
Yeah, my background is I've worked with a number of insurers, big insurers. I've worked as a managing consultant with EY. I've worked with Moody's, Towers Watson, Oracle. So, I've worked quite a lot in the insurance industry really for a very long while. So, I've been through, 40 Solvency II programs, 12 IFRS 17 programs. So a bit like Eduardo, we both got knowledge of the, the real world scenarios. So, yeah. Yeah, happy to talk anytime, but if you want online, maybe we'll have lunch when things turn to normality.
No, I think that's absolutely fine. So you can reach us at LinkedIn. I think that's the easiest, right? So just give us, send us a message, and then happy to take some of these topics into more specifics, because due to the limited time, the magnitude of IFRS 17 is always very, very difficult to condense. So there's of course much more to talk about, and much more things we can reference to as well.